Hello,
Hello.
and thank you all for coming to this second presentation this year at the Southborough Council on Aging, the Southborough Senior Center, and I want to thank the folks at the Senior Center for inviting me again. My name is Arthur Bergeron. I'm an attorney at a firm called Myrick O'Connell. There are 60 of us. There are 20 of us here in Westborough and 40 more in Worcester. Everybody does something special. I do this. I do nothing but elder law. And when we were thinking about the presentations for this year, we decided that we would take the first two presentations and make those the two general ones that containing a lot of facts that kind of everybody should know. And a lot of this is for you who have come here. A lot of this is for people who are at home who can't make it because they're taking care of somebody or whatever. That's why I really appreciate the fact that Southborough Cable is here. And they've got a person here. We really appreciate it. So in the first presentation in Elder Law 101, we talked about what to do when you're just starting to slow down, and what the documents are that you need, and a whole bunch of stuff. And then 102, which is today, is all about benefits. It's all about the things that you may be eligible for in order to help you, and in order to help you especially if you are something like my friends Frank and Mary. Frank and Mary, may have met before if you've been here. Frank and Mary and their children, Peter, Paul, and Mary Jr. And Frank and Mary live in their own house. And their goal is to die and be buried in the backyard. If one of them dies, they'd like everything to go to the other one. And if the two of them have died, they'd like everything to go to their kids. Does this sound kind of a familiar, kind of basic pattern? Their assets, they've got a home, modest home, $300,000. If he has an IRA worth $170,000, they have an annuity worth $100,000, they have bank accounts worth $80,000. So they've got total assets of about $650,000. Today, not a huge amount of money, but there's no mortgage. This is all good news. He's got an income from Social Security of $1,500 and from a pension of $500. Her income is half of his, or $750. That's the Social Security amount. So between the two of them, they're getting about $2,500 a month, or about $30,000 a year. Once again, they don't have a huge income, but as long as they don't have major medical issues, they're in balance. They're not needing to be really spending down their assets right now. And their questions that they ask are, how do they implement their basic goal, which is they want to die and be buried in the backyard, which means they want to live for many more years there in their house, and they want to know how they can do that. Well, there were really two pieces of that, and we're going to talk about both pieces today. The first piece is protecting the house and making sure that the house, as Frank and Mary get older, has improved or changed in a way that continues to make that house safe for them. Because as I always tell my clients, living at home is just terrific, and getting older is not so bad. I just turned 65 myself, had to try to figure out Medicare. I appreciate these issues. Getting older is not great, but it's not terrible as long as you don't fall, as long as you don't get hurt. Or if you're experiencing any memory loss or any of these issues, as long as it's still safe for you to be at home. So the first question is, how do you make your home safe? Now, we have had in previous presentations a really wonderful woman named Carol DiRienzo. I think we may bring her back for this fall to talk about the kinds of modifications you can make to your house to make it safe. She's a nurse by profession, and her husband is a builder, and one of the things that they do is they'll actually go to your house and look at it and go room by room and make some suggestions to you about how you can adapt that house to make it safer if you have one disability or the other. But of course, all of that stuff costs money, and if you're Frank and Mary, you've got a house that's paid for, you don't have a lot of extra cash, and so you don't want to dip into that unless you really have to, because you don't want to run out of money before you run out of life. That's one of the not the great possibilities, is that you run out of money while you're alive. So the issue in that case is how they would pay for those kinds of home improvements, which can run $10,000, $20,000, $30,000, $40,000, $50,000 to do them. So that's the question. And what I'm going to start off by talking about the three ways that you could do that. And they're all reverse mortgages, right? And one of them is what you always think of as a reverse mortgage, but then there are these two others. So I'm going to start with the home modification program, which is actually a reverse mortgage that you can get from the Commonwealth of Massachusetts. It's your tax dollars at work. If you have a disability and you need, in the opinion of the Disabilities Commission, or actually in the opinion of the folks who are administering the program, which in this area is the South Middlesex Opportunity Council, located right over in Framingham, but they'll come right over to Southborough. If the repair that you're doing to your house, or the modification, whether that is a ramp or something having to do with stairs or any number of things in the kitchen, right? Or in the bathroom, all those things that you kind of wouldn't want to do because they're so expensive, right? If that's the case, if you need them, in their opinion, and believe me, these are folks who are very generous when it comes to figuring out whether you need them, right? And whether or not there is an appropriate disability that you need to get taken care of, then the Commonwealth will lend you the money to fix that stuff, all of it, and they'll charge you either low or no interest, no monthly payments, and the amount isn't due until the house is sold or you die. This is exactly how a reverse mortgage works. It's exactly how a reverse mortgage works. That's really what it is. And they'll lend you up to $30,000. Now, this slide is a long ways away from the folks who are filming, but this is on your table. So the question is, when do you qualify for a zero interest loan? You must have to be really poor, right? Well, if you're Frank and Mary, you can qualify for a zero interest loan, if that means you're a family of two, if your income is less than $78,800 per year. That's a lot. I mean, it's not a lot, but it's a lot. I mean, for folks who are retired, if your income is below that, you qualify for a zero interest loan, right? No monthly payments. The money's due when the house gets sold or you die. If your income is over that but below $157,000 a year, you qualify for a low interest loan, for a 3% loan. You qualify for this program. So it's a very attractive program for folks like my clients, like Frank and Mary, who really, really want to stay home. They've got some modifications and they want to get them done, and they're not going to be hugely expensive. And by the way, you can qualify for this program while at the same time qualifying for a regular reverse mortgage. Now I'm going to talk about reverse mortgages a little bit. First of all, I never recommend these as anybody's first choice, and especially not if you're using a reverse mortgage or using the equity in your house simply because you just start retired and you're getting less income and you're trying to just supplement your income, because you can't deal with the fact that your lifestyle is going to shrink a little bit because you're now not earning anything, or not earning, you're not out there in the workforce. I mean, if that's the situation, this isn't a good idea. However, if you are Frank and Mary, going back to the goal of this presentation, if you're Frank and Mary and you've got big repairs that you want to get done in the house, right? But you don't want to dip into the $300,000 or $350,000 that you have in cash because you want to keep that as a reserve, then these are a great idea, right? Because you borrow the money. You can, if you want to keep the amount that's owed on the house from growing, you can make the regular monthly interest payments, but you don't have to. People will often say, well, why don't I just get a home equity loan, which many people have done. And I'll tell them, I say, well, that's fine to get a home equity loan, except the only problem with the home equity loan is if you don't make the monthly payments, they foreclose, right? This one, they don't. Okay, so let me just talk about this for a little bit. So in order to qualify, if you're Frank and Mary, you both have to be 62 years of age or older. How many people here are over 62? So a lot of you would qualify. The amount that they will give you is a percentage of the value of the house, and the percentage is based on, or the amount is based on, of course, the value of the house, and then the percentage goes up the older you are, which makes sense. If you're 95, they're pretty sure that they're reversed, and the mortgage is due on death. They're pretty sure they're going to be getting their money back fairly soon. It's different if you're 70 or you're 62. So that percentage is going to vary. And the way that I recommend that people use this, and that's why I would recommend it for Frank and Mary if they were thinking about this, is you use it as a line of credit. You get a loan, and you get a loan for the maximum amount you could get, whatever that is. And we're going to talk about that, how much that is, but you don't pull any of it out. Or you only pull out the money that you're using in order to fix up the house. And then you leave the rest of it as a reserve. So how much could you get? Well, these numbers are about 45 days old. When I originally did these numbers, this was true. At that point, in terms of the amount you could get, that's still true. The amount you could get if you're Frank and Mary and you're 70 years old and you have a house that's worth $300,000, you get money in kind of two tranches. the first right away and the second after a year, right? So the amount you could immediately get if you're Frank and Mary, if you're trying to do these repairs like right away, is $103,000 on a $300,000 house. In the second year, you get additional money. The total that you get can't be more than $167,000. Well, aren't the interest rates really high on these things? Well, actually, they're about what you'd be paying if you've got right now a line of credit. If you've got a home equity loan, they're adjustable rate mortgages. They're 3.7%. It's kind of the average. And by the way, when I talk about the typical reverse mortgage, it's because they're all basically the same. I mean, you know, you see the ads on the TV and you hear things on the radio, and they're all trying to sell you their reverse mortgage, but they all work exactly the same. The reason why is that they're all insured by the federal government. The only reason why anybody goes into this, any bank, is they know if for some reason by the time you die more is owed on the house than the value of the house, they're still going to get their money back. And the reason for that is that these are all federally insured, so the federal government pays them. And part of what you pay when you, in the kind of entrance fee to these is basically into a pool of money. It's like an insurance pool. So they all kind of work the same way. So the interest rate now on a variable rate is about 3.7%, so it means it can go up, but there's a cap. It can't go up more than 5 points, so the interest rate, no matter what, can't be higher than 8.7, which for any of us old folks who remember, there was a time when 8.7 was a low interest rate. You know, we're just used to it being like 3% now. So there's that, and then the big one, which every client of mine will tell me, I don't want to get a reverse mortgage. I heard those closing costs will kill you. They'll just kill you. Well, that's the closing cost right now on these reverse mortgages, $4,062 to get that reverse mortgage. Now, if Frank and Mary were 80, because they're older, they can get a little bit more money, but not a lot. They can get up to $118,000 right away, and they can get over the life of, they can get after the first year up to $192,000. Interest rate's the same, closing cost is the same, right? Now, once again, this isn't Frank and Mary's first choice. You know, if they had a lot of cash around and they were just going to pay in cash, they pay in cash. But if they were 90, they'd say, well, you know, just use some of the cash. I mean, how much more cash am I going to need? I'm 90. But if you're 70 and you want to keep that pot of money, this is an interesting way of doing it. Okay, so that's number two. Number three, the third home or reverse mortgage you can get is from the town of Southborough. Who knew? The town of Southborough, if you are over 62 years old, will allow you to defer all of your taxes. All of your taxes. Now, this is in addition to the fact that if you are a veteran or a widow of a veteran or meet other criteria, you can get an exemption and reduce your taxes. But all of the rest of the bill, you can defer until when? Until you die or you sell the house. Oh, by the way, that's what reverse mortgage says. You don't owe the mortgage unless you die or sell the house or move out of it. Leave the house for at least a year. So in this case, if you die or sell the house, then these taxes that you have deferred are due and payable. In order to qualify, you have to be 62 years of age or older. There is no asset limit. You can have $1 million in cash. You can have $1 million house. Still qualify for this program. There is a state requirement. There are two state requirements, and I'm going to talk about those. One of them is that there is an income cap on this program. There's no asset cap, but there's an income cap. And the state says that income cap is $20,000 for a family. $20,000 for a family. So Frank and Mary, in general, wouldn't qualify. However, the state says that an individual city or town, by vote, can increase that cap. Well, as it happens, you've done that at town meeting. You have increased that cap. And so you can actually have income of up to $40,000 a year and still qualify for this. $40,000 a year, right? So Frank and Mary, in this case, would qualify because their income, recall, is only $30,000 a year. Now, as to the deferred taxes, the town will charge you an interest rate. And the interest rate, the state says, the interest rate cannot be higher than 8%, but a town can set its own rate. And as it happens, Southborough has done that, and they've reduced the rate to 4%. So if you were deferring your taxes this year, all of your taxes until you die or sell your house, the interest rate on that deferral would be 4%, which is about what you'd be paying if you borrowed the money from the bank on a line of credit loan, right? Or if you used the reverse mortgage. Now, this varies from town to town. For example, your neighbor, actually Marlborough has exactly the same rules that you do. $40,000 income cap and a 4% interest rate. Westboro, on the other side of you, also uses the $40,000 number but charges zero interest. Zero interest. Ashland actually allows you to have income of up to $55,000 and charges you, I think, 2%. So this varies all over the place. The reason why I mention this is, if you go to town meeting, you can vote on this, right? You vote on this. This is a really important issue. And to me, as a public policy matter, this makes perfect sense for the town to do. Because what are they doing? They're not giving you anything. They're lending you money. And as a result of lending you money, they're allowing you, who are voters and citizens, and there is a time limit. You have to have been in the house for, I believe, at least 5 years. They're allowing you, who have probably been here for a long time, to stay in your house. Hopefully to stay in your house until you die. What's wrong with that? You know, I've had clients. I have a client actually in Hudson who is in terrible shape because in Hudson the income requirement is only at $20,000. His income and his wife's together are like at 25. But he's trying to take care of his wife who is at home, who has dementia. He's doing all kinds of things. He's got extra help coming in through a program that I think we might talk about called the Frail Elder Waiver. But still, he's got this big tax bill, and he can't defer any of it, right? And it's his biggest bill. You know, the medical is being covered. So this is like a big deal. So there are these vehicles available to Frank and Mary and to you if you want to stay in your home. Then the next question is, well, we talked about that. Oh, and you can do that tax deferral while at the same time doing a reverse mortgage, or at the same time doing the home loan modification program. So we figured out how to fix up your house. Then the question is, so how do you get to stay in your house, even if you need some additional services in the house? And what do you qualify for? Well, the answer to that question is talk to them. Talk to Bay Path Elder Services. Bay Path, the state is divided into 27 regions. Each region has an Aging Services Access Point, or ASAP, in it. This region, which includes 14 communities, including all of the boroughs, and then it kind of goes east from there. It goes east as far as like Wayland and Dover and Sherburne. Within that area, the ASAP is Bay Path Elder Services. They're located right over in Marlborough. They've got a lot of staff. They will answer your call if you call them and just talk to you about what your situation is and basically tell you what you're eligible for. They are the vehicle through which all state and federal money flows to you. All elder benefit programs. By the way, they are also the entity that would certify if you were eligible for Mass Health for long-term care services, or if you're eligible for home services to keep you out of a nursing home. We're going to talk to you about that a little bit more. So you want to know these people, and don't call them. Well, you can call them obviously if it's an emergency, but the best time to call them is now. Just give them a call. Say, this is you. You live in Southborough. You're in their area, and this is your situation. Are you eligible for anything? Just ask. I mean, it's not like charity. You know, this is like your tax dollars at work. I mean, among other things, that's their towns. Among other things, they run the Meals on Wheels program. These ASAPs were created under the Older Americans Act in the 1960s. One of the many things that Lyndon Johnson gave us. Medicare, a lot of big things, including the Older Americans Act, and Meals on Wheels. That's when it started. And they have always administered this. They do the Lifeline subsidy program. You know Lifeline, the thing that you wear around your neck. And so if you have a heart attack, you press a button and the ambulance shows up, right? So my wife and I were in Houston a few weeks ago visiting her sister. And she lives alone. She's in a very nice townhouse condo. And while we were there, she had a seizure. She's had seizures for years and years. So she just dropped to the floor. She would have been dead. She would have been dead. Because she has a Lifeline but didn't have it on. No way she was getting to the phone, right, to deal with this. Fortunately, my wife was there. She called 911. We got the ambulance. But this is a wonderful service, and they'll help you pay for it. And as I mentioned, they'll give you advice regarding everything else that you might qualify for. And I'm going to talk about one of those more in detail, or one cluster, and that is home care. For so many people who are at home, and I know you don't want to have any strangers coming into the house, and you'd rather have your daughter come over. You'd rather have your son sometimes, but they're usually useless, right? You usually want your daughter to come over, help you out, right? Usually there's a designated daughter who kind of comes over and takes care of things. So But if you need more help than that, or your daughter, even though she hasn't said anything, is dying because she just doesn't have all that time to get over. So you need help. There are several programs funded not through the federal government, but through the state. Your tax dollars at work, the Commonwealth of Mass. One of them is a program called BASIC. I don't know why, that's a pretty straightforward name. And the point of the program is to provide you with a limited number of home care hours. People who will come to your home, they get paid to come to your home, help you out. Make a meal, do the grocery shopping. This is not meant for having a lot of home care because you actually need help with like dressing and toileting and other things. This is just to kind of help you out, right? Through the BASIC program, they will give you up to, if I recall correctly, 6 hours a week of services. Through a more extended program called ECOP, I have no idea what that stands for, but it's called ECOP. They will give you up to 12 hours of services a week, or do the math, that's about 50 hours of services a week. There's no asset test for this program. You can have unlimited assets and qualify for all this, right? There is an income test. Now there's a chart that you're not going to be able to see very well from a distance, but what it says is if there's a copay. There's a copay on this program. But if you're Frank and Mary, if you're a family of two, earning what they earn, your copay would be $101 a month. Now, figure it out. If you were getting 12 hours a week of home care, the market rate for home care right now is probably between $20 and $25 an hour, right? So for 20 hours, 50 hours of that would be $1,000 to $1,250 if you were buying that care. Through this program, you're paying a $101 a month copay instead. Right? You're paying 10% of the cost of the service. This is a great deal. And there's no asset cap. And the income, once again, there's just like a copay. So don't assume that you don't qualify for this if you think it would be helpful. You know, and I know the tendency on these is to always say, oh, I don't want to take charity. I don't want strangers in my house. You know, and I get all that, you know. But you know, if the person shows up and you don't like them, you don't have to let them stay. Get rid of them, right? Tell the folks at BayPAC you want somebody else. It isn't like you have to take them. This isn't charity. It isn't like you're accepting charity. You're simply using the programs that you pay your tax dollars for. So those are those two programs. Then there is this kind of major program called the Frail Elder Waiver, and we're going to talk about that a little bit more. So to qualify for the Frail Elder Waiver, this is the more advanced program. The goal of the Frail Elder Waiver program is to allow Frank and Mary to stay at home, even if, for mass health purposes, they could actually qualify for nursing home care. Now, to qualify for nursing home care, medically, you have to show BayPath Elder Services that you either need assistance with at least 2 of the activities of daily living, and this doesn't need to be assistance every day, even though it says activities of daily living. But the activities are dressing, bathing, eating, toileting, and transferring. Transferring means getting out of a chair, going across a room, sitting down. If you need assistance with at least 2 of those, then as far as mass health is concerned, you're eligible for nursing home care. Now, I realize that's not when you would want to go to a nursing home, right? That's like your last resort. But it's important to know the standard because this is what qualifies you for the Frail Elder Waiver medically. So either you need that assistance, or you need to require, in the opinion of BayPath Elder Services, regular supervision. Like if Mary is kind of slipping, Frank needs to be there all the time because Mary might wander. Okay? So if you need that, then medically you qualify for the Frail Elder Waiver. Excuse me. And I'm going to talk about a little bit more about the financial qualification in a second. Finally, the Veterans Aid and Attendance Program. I'm just going to talk about this briefly because this is more specialized and only affects some of you. But if you were in the military service for at least 90 days, or your spouse was, or you're a widow and your deceased spouse was, if at least one of those days was during a period of war, then, and I gave some dates about war because it's always a surprise to people to find out that World War II ended December 31st, 1946, even though the bomb got dropped in August of 1945. So there are a whole lot of folks that when you do this, they're kind of surprised that they actually are eligible because they've served. And you don't have to have served overseas or anything, you just have to have been in before that date. I just had a person who now is qualifying for this, who was astonished because he went into the service in late 1954, which for their definition, by their definition, Korea was still going on. Well, nothing had happened in Korea at that point since about 1952 when Eisenhower got elected, but for their purposes, it kind of drifted on. So if you served at least one day, then you're eligible for a benefit to help you pay, once again, for this kind of added home care or other services that are coming into the home. And if you are, now there are asset limits on this program. Contrary to the myth that you may hear, if you were a veteran or have heard about this program, the asset limit is not $80,000. It's whatever the VA says you need in order to live for the rest of your life. You can still gift away assets in this program. There has not a look-back period yet, although Congress is considering that. And if you have too much in assets, you can restructure those assets by simply taking the amount that you are over and buying an annuity with it. So there are easy ways of qualifying. The benefit can be as high as $1,644 for Frank, if Frank and Mary are both still living at home, or if Frank is dead and it's just Mary who needs the help, $860 a month. So this is a program that's worth somewhere between if you're Mary, about $10,000 a year, and if you're Frank and Mary, about $18,000 a year, just to help you stay at home. Finally, a few words about Mass Health, Mass Health 101. If you qualify if you medically qualify using the standard that I just talked to you about for nursing home care, then if you're Frank or Mary, you also qualify for the frail elder waiver, except that you have to meet an asset test. Now remember, those are Frank and Mary's assets, right? So they've got a total of $650,000. And Mass Health, which is the state name for the Medicaid program, is health insurance for the poor. So you have to show that you're poor. But if Mary can say that she's otherwise eligible for nursing home care and therefore wants to qualify for this frail elder waiver, she has to show that she has less than $2,000 in countable assets. But Frank can have unlimited assets. And she can shift her assets to Frank at any time. There's no look-back period. So in this situation, if Mary qualified, if BayPath said to her, and said to Mass Health that Mary was otherwise eligible for nursing home care because she needed help with those two activities of daily living, right, or because she needed the supervision, then all she would have to do to qualify financially is the next day she'd transfer the house to Frank, she'd transfer all of her other assets to Frank. This last one would only apply if she needed to qualify for the nursing home. If she was in the nursing home, she could still qualify by shifting all the assets to Frank, but in that case, Frank would have to basically buy an annuity in order to cause his assets to be below this $119,000. If Mary is at home, though, Frank doesn't have to do that. Mary can simply shift all of her assets to Frank, and the next day she qualifies for the frail elder waiver. Now, what does that give her? It gives her whatever number of hours Mass Health says she needs, or BayPath Elder Services says she needs. If BayPath says, she needs 30, 40, 50 hours a week of home care in order to stay at home and not go to the nursing home, Mass Health will pay for all of them. There's no copay, okay? Now, the only thing that Frank is going to want to pay attention to in that case is he doesn't want to die. You don't want to die and leave your wife, in that case, with all these assets, because in that case, now she's way over asset, so she couldn't qualify. But Frank could take care of that by simply, once he's got all the assets, changing his will to say that following his death, instead of his wife getting all of the assets would get held in trust for her benefit. He could name one of his kids as the trustee. And that would protect all of the assets. The assets could be used for Mary's benefit, but wouldn't be countable by Mass Health and wouldn't be lienable. And this can happen at any time. Once again, this can happen at the last minute. It can happen the day before Frank dies. He can write a will like this and shift everything into his name so he can protect his wife in the event that he dies. If Mary has died, or excuse me, if Frank has died and hasn't done this though, and Mary has all of those assets, then now she has more of a problem. This is the problem that gets solved, and you all know about this piece, about doing something, transferring your assets out and waiting 5 years. You all know about this rule, this 5-year look-back period rule. Only applies if the spouse is single, and therefore needs to be transferring assets to a third party like the kids, as opposed to transferring to the other spouse. In that case, Mary would really would have to look at gifting assets away. Any assets she wants to protect, She needs to gift it away. She could do that with her house. She could do it with any of the other assets. Finally, a couple of words about long-term care insurance, specifically if you're Frank and Mary in this case. As I mentioned, and I talked about long-term care insurance for a while in Elder Law 101, and I told folks, I said, ironically, that the purpose of long-term care insurance, you would think, is to cover your nursing home costs. But you really don't need to do that if you're Frank and Mary, because you can always qualify for Mass Health. The only reason that I suggested you might want it when I was talking in Elder Law 101 was actually not for the nursing home benefit, but because of the home care benefit. Many of those policies will also provide you additional assistance at home. There is one exception, though, to that general rule that you should know, and that is if you have a policy that says that the insurer will pay $125 a day for at least 2 years that you're in the nursing home, then if you need nursing home care, that policy will protect your house. It will keep you from having to sell the house. It will keep there from being any lien on the house. It will keep there from being any claim against the house after you die. It will protect the house no matter what the house is worth. It can be $1 million house. I do a lot of work in Martha's Vineyard and in Nantucket, where everybody has $1 million house. Well, not in Martha's Vineyard, but like in Nantucket. It's like everybody's house is worth $1 million. So, and I tell them, I say, you know, as long as you have this policy, no matter how valuable your house is or gets, it will protect all the value. The only thing you have to make sure is that if you go to the nursing home and you apply for Mass Health, you have to say in your application that it is not your intention to return home. You have to just say no. The reason why I say that is that most times when you're applying for Mass Health, no matter, even if you have no ability to ever return home, you're going to check off a little box that says that you do intend to return home. Because as long as you've checked off that box, Mass Health doesn't require that you sell the house. They'll put a lien on it and they'll want to get repaid after you die, but they don't require that you sell the house. In this one case, though, if you check yes, that you intend to return home and you get approved for Mass Health, you have now eliminated the protection that you would have gotten from your long-term care insurance policy. I know that doesn't sound fair, but that's just kind of the way it is. So finally, if there are any of these issues that you want, I tried to cover a lot of material that you want to hear about again. Frank and Mary have their own YouTube channel. It's called Elder Law Frank and Mary. You can see this again, or any of the shows that we do, or watch it on Southborough Cable, which I know that they'll be rebroadcasting this program. And that's the goal of the exercise, peace of mind. The goal of life, especially as we get older, is to sleep well at night. So if this has helped, I'm glad of it. Any questions regarding any of this?
You don't have any of that on disc.
Yes, sir. Do I have it on disc? No. No, I don't. I'm sorry. We do the YouTube channel instead, so that people can kind of have access to it, or you'll be able to see it again on Southborough Cable. Any other questions? Any questions regarding any of this? If not, I'll be glad to stay around for a few minutes afterwards, answer any questions you might have. Enjoy your summer, and we'll see you all in the fall. Okay? Thank you very much.